In today's video, I'm going to air my dirty laundry and I'm going to share all the investing blunders that I've made along the way, so hopefully you won't make the same mistakes that I have. Now, the list of my mistakes is quite exhaustive, but I figured we could narrow it down to the top 6 so I don't embarrass myself too much, and maybe you'll share your early mistakes and commiserate with me a little bit. Like most new investors, and maybe even some seasoned ones, I didn't know what I didn't know. I was optimistic and hopeful, which I still am. I was a baby investor, and that newly downloaded investing app had my endorphins flowing. Not to mention the article I just read that gave me all I needed to know about how to turn my $100 into $1 million. I was going to buy stocks. And so with a mostly blind leap of faith, I hit the buy button. And a week goes by, and my investment is down to $50. But I'm hooked because I fully intend to win at this game. So mistake number 1, as I ventured into investing, was truly my lack of knowledge. There's too much at stake when you work your butt off for that $100, and blindly throwing it away wasn't going to help me be a winner in the game of investing. So my advice to you is to educate yourself. I recently asked you all, how did you learn about investing? And I was really shocked to see that 88% of us are self-taught. But as you venture into the world of investing, find those websites available where you can learn all about it, like Yahoo Finance, FinViz, Investopedia, and Seeking Alpha, which is my personal favorite place that will actually provide you with alerts whenever your holdings are at risk of performing badly, and also will allow you to review in great detail the fundamentals of any company so that you know you're on track. You can review the summary, the news, the ratings, the financials, information about the dividends, and you can even look at the total return of a company. The more you understand, the more successful you'll be. So read, watch, listen, hoopla, library, podcast, and learn how to evaluate a company to see if it's going to meet your strategy. Which brings me to mistake number 2. I started my investing journey, you guys, with no knowledge, no plan, no strategy. I hardly knew where to start or where to go for information and education. But over time, through countless hours of reading and researching, I started to formulate a plan. And I recently asked you all to find out what your ideal number of holdings in a dividend investing portfolio would be. And when I look at this, we've all got a different idea and a different comfort level. And I also asked what the maximum percentage that you would hold in any one individual stock in your portfolio. And here's the results. So as you work to create your own strategy for investing, some things to think about. How many stocks would you hold versus the potential to maybe invest in an ETF? Do you plan to hold all individual stocks? Are there other assets that you might add to your portfolio? How are you going to weight each of your holdings? Do you have a maximum percentage that you might invest in any one asset? How much time do you have to invest? When do you need the money? And do you truly have time to monitor your portfolio, or do you need a more passive path to wealth where you can set it and forget it? These are all questions that you should ask yourself before you get started. One of the primary reasons why investing without a strategy can be harmful is that it can lead to poor investment decisions. Without a plan in place, you might invest in stocks or funds that don't necessarily align with your long-term goals or your risk tolerance, which can result in poor returns, missed opportunities, and even significant losses. Another issue with investing without a strategy is that it can lead to a lack of discipline. Investing requires patience and a long-term perspective. Without a plan, you might be more likely to give in to short-term market movements or that emotional decision-making. Now, I did eventually develop a strategy that works for me, which I do continue to tweak along the way, and I've got a video outlining the steps that I took, but a few key points for me were debt-free living, a consistent review of all the investments that I have, during which I keep very specific performance metrics in mind, and consistent investing without emotion. Which rolls us right into mistake number 3 that I made. Now, we all see it. Every day, we're bombarded with analyst opinions, predictions, market analysis from news channels to social media. Everyone seems to have an opinion on how the market's going to perform. Have you seen the fear and greed index? We've got to be fearful when others are greedy and greedy when others are fearful. So mistake number 3 is listening to the news and all the strategists who pull you farther and farther away from your own strategy. Don't fall into the news trap by reacting to headlines and sensationalized media coverage. Trust but verify, and strip the emotion. Look at the numbers and really ensure that you have an understanding of how each of the company that you're investing in is operating, because emotional decisions can lead to significant losses, and it's impossible to predict the market, so don't bother trying. Learn to enjoy the ups and downs and invest for the long term, because if you're investing in a quality company, you'll be happy when the share price goes down, because you're going to get those shares on sale. Which brings me to my mistake number 4, which is attempting to time the market. All I can think of is attempting to learn to do double dutch. Has anyone ever jumped double dutch rope? I'm not even sure if that's the right way to say it. but I couldn't consistently get the timing right and invariably would end up tangled up in the ropes. Much like my elementary school jumping escapades, I haven't been too successful at timing the market either, and it's a common mistake made by newer investors and even some more experienced investors too. Trying to predict the market's short-term movements. There are some investors who attempt to time the market, who believe that they can buy those stocks at a low price and sell them when the market's high, and maybe even some of them are somewhat successful, but it's widely recognized that market timing is not a viable long-term investment strategy. In fact, it can be a significant risk to an investor's portfolio. It's nearly impossible to predict the stock market's movement with any consistency. The market's influenced by a multitude of factors, including economic data, political events, company earnings reports, and more. And it's difficult to forecast all these factors and how they're going to affect the market in the short term. And as a result, investors who try to time the market may end up missing out on opportunities or selling at the wrong time. Another reason why timing the market is a mistake is that it can lead to emotional decision making. Don't make emotional decisions. Remember mistake number 3? Let's not do that again. The best approach to investing in the stock market is to have that long-term investment plan that includes a diversified portfolio and regular contributions, buying solid companies at fair prices. If you haven't seen it yet, check out my dividend snowball video. It'll blow your mind what steady, consistent investing can do over time. Now, my 5th mistake was lack of diversification, which is really one of the fundamental principles of investing. This is where you spread your investments across different asset classes, sectors, and geographies. The primary objective of diversification is to reduce the risk of your portfolio by not putting all your eggs in one basket. Lack of diversification can lead to poor portfolio performance and leave you exposed to unnecessary risks. Investing in a single stock or sector is a common mistake made by newer investors, and it's something that you really should give some thought to when developing your investing strategy. How do you plan to diversify your portfolio? If all your eggs are in one basket with a high percentage of your assets in one sector or one single stock, and it starts to underperform, the value of your portfolio could decrease pretty significantly. Another thing to consider is that if you only purchase stocks from a single country or region, you might be missing out by investing globally, as this might reduce the impact of events in any one country or region. And my 6th mistake, which is probably my biggest, was not getting started soon enough. I'm in catch-up mode, and I'm trying to save and invest as much as I possibly can because I'd really like to have control over my time, which means establishing a passive income stream so I can live with more freedom. Did you know the average age when people start investing is 33? Imagine just how much wealth could be accumulated if we all just started a little earlier. So for those of you just finishing high school, just finishing college, please, 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 listen to those folks around you that are trying to guide you to start investing. This is my most regrettable mistake, and that I should have started much younger than I did. And that was really the impetus for starting the Hopeful Investor, to teach the fundamentals so that we can all reap the rewards, because time in the market beats timing the market. I put together a simple playlist for you all that reviews strategy, the basics of investing, goals, risk, how to analyze a stock, build a portfolio, and the dividend snowball video as a means of inspiration to just get started. So do it. Get started by watching those videos next. How do I keep her quiet, you guys? She's just incessant. I need like a padded, maybe not a padded room. I need a soundproof room. Maybe I do need a padded room. And today's mulch laying day, you guys. I got 16 bags of mulch that I've got to lay. So that'll be next on my list.